Good afternoon. Welcome to 25 Minutes with Cap. Today we're going to discuss FinTech and other emerging financial institutions risks. Alongside a rapidly hardening market, the space of financial institutions continues to morph and evolve with new business models and concerning risks. Who better to discuss this with me than Patrick Cagney, Senior Vice President of RT Specialty, and Blair Bartlett, our Head of Financial Institutions here at CapSpecialty. As we go on from here, as you have questions through the session, feel free to enter them into the chat, and we'll do our best to answer them. We've received a few questions already, and we'll look to address them in the next 25 minutes. Just a reminder that the content of this webinar is the property of CapSpecialty and is for informational purposes only. You're not permitted to republish, share, or quote from this webinar without the prior written consent of CapSpecialty, which can be obtained by contacting marketing@capspecialty.com. We hope you really enjoy the webinar. So Blair, we're going to start with you. When we've talked about FI in the past, we've been talking about banks, insurance companies, asset management firms. But now the business has gotten increasingly more exotic. We talked about financial technology, alternative lenders. While these firms are different, is the exposure basically the same?
I think it's in some cases yes, in some cases no. So I mean, when we think about fintech, there's typically, two kind of avenues they go down. One of which is let's find a way to take an existing transaction and make it more efficient, right? And make it less barriers for the client to get insurance, to invest in a certain asset class, right? Use technology to make transactions that have been going on for hundreds of years, more efficient or more, accessible to certain individuals or institutions. And when we think about it that way, then they're not that different in some cases. But then there are ones who are bringing to market a completely new investment product, or coming up with an entirely new type of transaction that hasn't been transacted historically in the market. And with those, I think that those are vastly different, right? So a lot of it is kind of saying, like, which of those two paths are they going down? Are they trying to increase efficiency and make things more accessible, or are they creating an entirely new asset class for people to invest in, right? And kind of depending upon which road they go down, I guess just decides how different they are from kind of the way that the business traditionally has been transacted.
Is the coverage continue to be standard, or the actual coverage that these people need, has it evolved?
I mean, I think by hosting and transacting in a nearly entirely digital business, it's evolved greatly, right? You have increased privacy and network security concerns. You have, system failure issues potentially, business interruption issues that, 50 years ago, nobody thought about, right?
Sure.
So, in that regard, it increases the exposure and the coverage needs, not only for that particular line of business, but also, any potential kind of event-driven litigation that could follow on there from.
Patrick, how much trickier is the sales process?
Yeah, I mean, it's really difficult, on both the broking side, when speaking with various underwriters and speaking with retailers and with the clients, because ultimately it's really difficult to sell this coverage to these younger companies and to these startups. A lot of times they're typically, in an early stage, really looking to coverage in place to satisfy a contract, whether that's D&O or whether that's just checking the box to say they have E&O coverage, whether it could be a contract with the bank or another third party, and they aren't really as focused at this time in terms of securing the appropriate coverage, or at least they can't afford it. So really they're much more likely to spend a smaller amount of premium where coverage in certain instances may be illusory, rather than paying up to get a broad product, maybe taking on a higher deductible or retention for coverage that's going to be all encompassing, rather than having gaps in it, which might be the alternative approach.
I mean, so there's a big difference between a stripped down E&O to satisfy a contract and then some of the stuff that Blair was talking about with the standalone cyber and employment practices. How are you generally seeing a big gap between what people need and just what they're buying?
Yeah, I think the biggest issue we see in the quote unquote fintech space is especially when a firm is offering a financial service in conjunction with some sort of technology.
Sure.
So a lot of times, historically in the market, it's sort of been split up between, insurance companies have a division that specifically focuses on tech and cyber, and then have a separate division that focuses more on financial institutions, D&O and E&O. And there's a gray area, between those lines when you have a company that's offering a technology product in conjunction with the financial service, where there could be, fingers pointed in the event of a claim where, there may be a mistake made on the technology front, but also involves a financial service like lending or whatever it may be. And those carriers are going to point the fingers at each other because, the tech policy is probably going to have an exclusion related to any sort of financial services, and the FI policy is probably going to have an exclusion related to any sort of technology E&O. So it ends up being a massive gap in coverage that a lot of times these insureds aren't even aware of because they haven't been properly educated. Right.
Well, going along with these types of businesses, let's talk a little bit about the D&O exposure in the space. As both of you noted, there's a ton of money flowing in as technology advances. Bolder and bolder proclamations are being made by those starting and building these businesses. It's a great time to be a company raising money in the fintech space. But Blair, what are some of the current concerns that you're seeing underwriting the business?
Yeah, I mean, I think one of the bigger concerns that we have is, a lot of these businesses are trying to disrupt the traditional transaction process by making it more efficient and making it more accessible, right? But like, as we've seen, even with InsurTech, which is familiar to all of us, I feel like we've been talking about InsurTech for a long time, and in our day-to-day, we don't really see a whole lot of disruption to the way we're conducting business, right? So how long do these companies, which are all venture capital backed, need to raise continuing capital till they actually start to get traction, until they actually start to change human behavior, and will investors stick with them, right? And then when you're talking about a financial institution, it's, you have an increased level of regulatory scrutiny on top of that too. So you have to worry about SEC or NASD, or FINRA now, I guess it's called. Or if it's an insurance company, you have to worry about, the departments of financial services or insurance in each particular state, and staying in line with those, and, the inability to kind of fund operations. Does that continue to have any effect on their ability to render services, and fund their ongoing business? And it seems like with these companies, their pathway for their investors to realize their investment is, with each subsequent round, they're not necessarily becoming more profitable or becoming closer to being profitable. It's all about increased usership. I grew my user base from this to this, and therefore I should have this valuation, right? And so the valuations on this stuff, as that usership or subscribership grows, just skyrockets to levels that, really don't necessarily seem justifiable by any reasonable person. It's all about that, it's really a bet that they're going to completely disrupt the way that business is being transacted, with some of those valuations, which we just haven't seen come true. And then it's okay, so then how do you make your realization of your investment if you're a VC investor and you've gone Series D, Series E? Well, sure. It's IPO, de-SPAC, or sell it to a business, right? So you could see an InsurTech get sold to an insurance company who says, I want that technology to underwrite auto insurance going forward because we think, pay per mile, or we think telematics is the way of the future, right? So we're not buying you because we think you have a great balance sheet and you have great loss ratios, but we're buying you because we want that technology, right? So I guess that's kind of one exit point for fintechs, but the other, these seem to be like the number one IPOing type of risk and the number one de-SPACing kind of risk too. So then you have that whole exposure to consider if you're, if it's a late stage company.
Pat, how's the market responding to this? Is Blair the only one concerned about these areas with financial technology, or are you seeing changes and contractions in the market, more questions, so on and so forth?
Yeah, I mean, to all Blair's points, I think it's a really difficult space in general. I think fintech is a buzzword that a lot of markets tend to shy away from because they don't understand it. They see a lot of added risk. A lot of the points Blair made. There's these companies with massive valuations. You run into dilution issues, things along those that nature, and the market is really being very cautious in how they underwrite to this. I think a lot of the perception of underwriters in this space is that some of these firms, may not have the background and experience of running a financial institution, and they're really just, tech guys who created this, this platform and, are really good at that, but they don't have the background, the experience in running a financial institution or the ability to create the compliance infrastructure needed, to do things the right way and be in compliance with various regulators, et cetera. So it's a really difficult space. Underwriters are still kind of figuring out how to underwrite these on a day-by-day basis. A lot of these have massive valuations, or as Blair mentioned, are looking to exit via IPO or otherwise. And underwriters in the D&O space in general are just struggling with how to underwrite to that and how do they, structure coverage appropriately from a coverage, retention, and premium standpoint to validate writing the risk.
What have you seen in the market in terms of changing of limits being deployed, particularly in this area? How much have people shortened up the limits?
Yeah, I think at most folks are offering, maybe a 5 mil limit on the stuff. And a lot of times they're cutting limits, down to 2.5, 3 million, where, historically you may have seen 5 mil and 10 mil chunks. You're having to build these programs or these towers and 1s, 2s, 3 mil limits max. And it just, it just adds a layer of,
Sure.
Complexity and, additional workload to build these, significant programs in such small limits. And on top of that, you're seeing, significant retentions. You're seeing underwriters pare back, the D&O coverage, maybe putting it on a public company D&O form, things like that, to really, address the massive exposure they see in these types of firms.
Because of the difference in pricing, have you seen people cutting the limit that they're carrying? Are people now making a choice between, maybe I used to be able to afford $20 million of limit, but now I'm choosing to only buy 10?
It depends on the company. Some of them are, some of the younger, less established ones are for sure, that, may not see the value in the insurance or may not be able to afford as much as insurance as they previously purchased. Those that are, I would say, gearing up for a potential IPO or maybe a de-SPAC transaction or something similar.
Sure.
We are still seeing them, get their D&O limits to a place they feel is appropriate, to lead into and to transition through that transaction. That being said, I think those limits are still probably significantly less than they would have been 5, 10 years ago when the coverage was much more affordable.
Right. Oh, thanks. Blair, you talked about a couple of different things around the disruption of business, the concern about valuations at the exit. How are you reflecting your underwriting through these changing exposures?
Yeah, I mean, the higher the risk, right? The higher flying the valuation, probably the less exposure I want to have, right? So, I mean, if we're having something that's gotten to like a Series D or Series E, and it seems like the next step is IPO, and you have, valuations that are multiples of revenue, not to mention hundreds, 100 times earnings or more than that. It's just going to be something where, if we like the business and we think the business has a chance to be successful, and it's going to continue to scale, and that they've done a good job getting it from, seed stage to where they are now, then maybe that's something that we're willing to, you know, to take a bet on, but we're going to take a small bet, right? So we're going to say, you know, 1 or 2 mil limits max, you know, excess only, and we're going to need a bunch of rate, right? Which I think is probably consistent with the way other people have approached it. And then on the smaller, younger companies too, you know, you kind of just want to see that they're having success at advancing the ball, right? So if you're looking at something that's like seed stage or early stage, you want to see that they're having some increased subscribership, increased usership, that their technology, you know, there are people who are adopting to their technology, and it has legs. And then it's something that, you know, you feel like, okay, this has a chance to be successful too. And in that case, but it's again, low limits and you know, I would say one of these fintech risks that, you know, if they're executing a very similar business model to someone who did it the traditional avenue in the past. So if you think about real estate, you know, there's real estate fintechs that basically make the opportunity to invest in residential real estate or in commercial real estate more accessible to retail clients, right? You know, some of those things have had success, right? And it's not a meaningfully different investment or exposure that we have on the kind of traditional avenue of going and calling on institutional investors and high net worth investors and investing in the same asset class, targeting the same returns, right? But the pricing is probably way higher, right? So for that same risk, it might, you know, they might be paying 2 or 3 times as much due to the kind of the fintech nature of their business.
You know, this is a question for both of you. And, you know, Blair, you were talking a little bit about, you know, high flying companies, multiple valuation. Are there certain areas that you just can't underwrite? You know, Pat, are there areas that you just can't place?
Yeah, I mean, I think there are absolutely. I think there are certain, you know, systemic exposures involved in these companies. You know, regulatory is a huge area. A lot of these companies are focused and aiming to, you know, attract sort of retail investors or retail quote unquote customers, which at the end of the day, those are the types of folks like us who are, you know, these regulators are there to protect them and their interests. So there's certainly an element of regulatory, which is difficult to quantify. And you see a lot of really, really high profile fintechs over the past 12 to 24 months that have been really targeted by these regulators. And then also, I think a separate area is really sort of third-party exposure in the context of, you know, a lot of these firms may utilize, you know, outside third-party service providers, or, you know, maybe a fintech uses a bank as part of their lending platform or whatever it may be. And a lot of this is to a degree outside of their own control. So you really have to underwrite to the sort of due diligence of selecting these third-party service providers, because ultimately our insured is going to get named or they're going to get looped into a lawsuit, even though it may not have been, you know, any of their wrongdoing. They're still going to get looped in and be on the hook for, you know, defense costs or whatever it may be in a suit.
Blair, are there areas where there's just no place, there's not a price, there's not a way of shaping the coverage to be able to underwrite it?
Yeah, I mean, I think for me, the scariest one are the fintech asset managers who are investing in a completely new asset class, right? Where, you know, I don't even understand the investment proposition that they're offering to their clients, not to mention they do, you know, and so, you know, kind of two that are kind of top of mind there, you know, are crypto, right? Like, what if the federal government just decides that they're going to ban all transactions in cryptocurrency, right? Then it's going to go to zero. And then, you know, same thing with NFTs or other digital assets that, you know, don't have meaningful value, right? It's all in the perception of the buyer, and, you know, there's no liquidity, there's no secondary market. So, you know, when you get into kind of some of these esoteric digital investment classes, it's just, you know, it's hard to see how that ends well. You know, it reminds me kind of the the synthetic CDOs and the CDO squared, and are these those asset classes of our time now? So I think anything like that is nearly uninsurable.
Pat talked a little bit about people wanting to fulfill an E&O contract with tech E&O, but it has an FI exclusion, and that being a place where maybe a carrier gets it wrong. What are some examples of where, of course not Pat, but where some brokers have gotten it wrong in terms of presenting FI risk?
Yeah, I mean, I don't know that there's so much data available on a lot of these insureds. There's so much publicly available information, and the brokers really do us a great job of getting all of the information we need to underwrite the business if we're going to consider offering terms. I mean, I would think the biggest problem that the brokers face is really kind of have Pat alluded to, was that kind of gray area between coverage sections, whether it's D&O and E&O, or tech E&O and financial services E&O, or tech E&O and cyber. And that risk is really blurred with these guys, and there's not really, to my knowledge, there was one carrier that kind of had an all-in-one solution to all those exposures. But outside of them, which I think that they've kind of pulled back quite a bit, there's really not a good solution out there. So, I mean, they're just, I feel like they're doing their best to kind of cobble together the pieces that they need to cobble together to adequately protect their insureds. And, from an underwriting standpoint, I'm only willing to do the parts that I want to do, right?
Sure.
So I think it's a struggle.
Pat, there's a question that we got in here. You had mentioned some of the private companies now being written on public D&O forms. Are there any other coverage restrictions that you've noticed in the market to comment on here?
I would say that's probably the biggest one. I would say from a true coverage or contract standpoint, I think that's probably the biggest pullback we've seen is taking risks off these traditionally broad private company forms, or pulling back the coverage to make it more, similar to a true public D&O contract, where we're just, protecting individuals and entity only, or securities only claims for the entity. I think more than that, you're just seeing carriers be even more cautious over the past few months in terms of, whether or not they're going to offer sort of a tech cyber product for these types of firms.
Sure.
We've seen the cyber marketplace harden substantially over the past 6 to 12 months. So even more so, we've seen, historically where a tech and cyber market may have considered a fintech risk and just done it very opportunistically, at their own terms. They're just outright, declining these risks out of the gate. So it just makes it even more difficult these days to find a solution for these firms. But outside of that, I mean, I'd say the public D&O form sort of approach is probably the biggest area. And then you may see some folks tighten up in certain areas, like, major shareholder exposure, when you're dealing with these massive valuations, and maybe you have a large investor that doesn't have board rep or something like that.
Mm-hmm.
They may look to address that by specifically excluding them. But outside of that, that's probably the main areas that we've seen.
Let's get Blair. Other areas to add in terms of coverage restrictions?
Not really. I mean, we only consider it basically from a D&O and E&O standpoint, right? But certainly we're not trying to cover any cyber claims, in those coverage sections, or any tech E&O claims. So, I mean, those are, definitely the things where we're trying to wall off exposure. Most of them we write on an excess basis and not a primary basis. So we're kind of less concerned with our choice of form, obviously, as it relates to private company or public company coverage. Sure.
Well, hey, we had a few more questions here, but we're up with time. So what I'll do is maybe I'll send some of the questions and answers out to the people who had joined up here. But really appreciate everyone's time. Blair and Pat, thanks a lot. And if you guys have any, those who joined, if you have any other questions, feel free to put them in the chat. I'll keep it open for a little bit, or send us an email. But thanks for joining on. Appreciate it.
Yeah, thank you.